Yeah, so as I was saying, in this case, what we learned in our previous class, in this case, we looked at current taxes and, of course, deferred tax under income taxes. And, of course, in this case, we were able to focus so much on how, in this case, you eventually determine what we call what? The deferred tax. The deferred tax. And the reason why in this case, we said that this particular standard has to be considered in the presentation of financial statements. It is because there's a difference, in this case, what we mean by accounting profits. There's a difference when we talk about accounting profits and what we mean by taxable profits. Taxable profits. Now, the profits in this case, the taxman will be able to consider when he's computing the taxes is different from the profit the accountant, when he's preparing the financial statements, will be able to, for example, arrive at. So that's why in this case, we said we have to be able to harmonize the two. We have to be able to harmonize the two. For example, in this case, to be able to know, for example, what could be the deferred tax that in this case, eventually, the taxman could actually end up having to claim in future. So if you happen to miss out on our previous class, kindly be able to watch that particular video so that in this case, we can actually be at par. But of course, we said the one that in this case, the examiner focuses on having to test a lot is actually what you're calling what? The deferred tax. How you can be able to arrive at the deferred tax. And of course, you said for you to get the deferred tax, you have to get something we call what? The temporary differences, which in this case is equals to the carrying amount. Carrying amount is equals to the carrying amount minus what we call what? The tax base. The tax base. The tax base. So in this case, the carrying amount, this is basically in this case, the carrying amount of an asset, or basically in this case, what the accountant will be able to report in the books of accounts. So you have to minus what the taxman will be able to consider as a value of an asset or a liability. When you get the difference between the two, you'll be able to get the differences between what the accountant is considering and the taxman will be able to consider whenever, for example, in this case, he has to determine how much you are supposed to pay as what? As a tax. When you get the difference between the two, you'll get what we call what? The temporary differences. So therefore, the deferred tax will be the tax rate, that you've actually, for example, been given. Maybe it can be 30% or 20%, multiplied by what? By the temporary differences, And because we said the difference between the two can either lead to what we call a tax liability. It can lead to what we call a tax liability, or it can lead to what we call what? A tax asset. A tax asset. And of course, in this case, when you get a positive, when you get the difference between the two and you get a positive, that will be a tax liability. When you get a difference and you get, in this case, it is actually what? A negative, or it is deductible. Is a deductible liability in this case, then in this case, it will end up having to lead to what? A tax asset. So that is basically, in this case, what we learned in our previous class. So there's a question I left that you are supposed to look at as an assignment. I want us to be able to wind up with that particular question before we can be able to move to another area. So I think I've been able to share the question in the group, the past paper question in the group. So it is April 2022. I think it's April 2022. April 2022. Question number, it's April 2022, question number 5B. So kindly open. So there's a past paper I've been able to share. You can open it so that in this case, we can be able to move together. April 2022, question number 5B. 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 So confirm whether you can be able to access the past paper question so that we can be able to move together. Confirm whether you can be able to access the past paper question so that we can be able to move together. I've already shared it on the group, so I think you should be having it. I can see David says yes. I can see that someone else is saying yes. At least a number of people should be able to confirm they have been able to access the past paper. It is April 2022, question number 5B. I can see Ikapel says yes. Ikapel says yes. So we can go through the question. So the question reads, Zion Limited, a public limited entity, is in the process of finalizing its financial statements for the year ended 31st of October, 2021. So the following information has been extracted from its accounting records for the purpose of estimating the deferred tax balance. Inventory is stated in the financial statements at the lower of cost and net realizable value. The company wrote down its inventory by 120 million to a net realizable value of 1130 million. The reduction in value is ignored for tax purposes until the inventory is done is sold. Then trade receivables had a carrying amount of 450 million after making a general provision for doubtful debts of 30 million. The provision is not allowed for tax purposes. Property, plant, and equipment has a carrying amount of 3050 million and a tax base of 2750 million. During the year ended 31st of October 2021, property was revalued upwards by 150 million. During the year to 31st of October, that is number 4, development expenditure amounting to 450 million was capitalized. Amortization of 20 million was charged to profit or loss for the year. This development expenditure was allowed for tax purposes in full during the current year. Trade and other payables are carried at 600 million. Included in the other payables are accrued expenses of 100 million, whose related expenses are deductible for tax purposes. Number 6, deferred tax liability at the start of the year, actually, it is actually 272 million. The income tax rate of 30% is actually applicable. Required, compute the relevant temporary differences. Then number 2, the deferred tax account. Prepare the deferred tax account as at the end of of the year, as at the end of the year. So the first question here basically wants us to be able to compute the temporary differences, And of course, now in this case, as you've already been able to indicate, the temporary differences, you'll be able to get them by simply getting the difference between the carrying amount of the assets minus the tax base, what the taxman would have considered as the amount to be taxed on these assets. So therefore, in this case, to get the temporary differences, in this case, we'll be able to consider. So we have the carrying amount. Then in this case, we'll have the tax base. So the difference between the two will be able to give us the temporary differences or the TD. The temporary differences or or the TD. So in this case, that is what we are looking at. So when you minus, you get the difference. So we can be able to have our table there. Remember the amount, our amount there is actually in shillings of Of million. Is actually in shillings of millions. Our amounts are actually in shillings of millions. Our amounts are actually in shillings of millions. Are in shillings of Of millions. So we'll be able to get our temporary differences. Then from there, we can be able to get our deferred tax. Remember, when you talk about the carrying amount, it is the amount that was considered or the amount that is actually in the books of accounts. The amount that in this case is actually where? It is actually in this case in the books of accounts. Just a minute. So I think that's a bit visible. So when you talk about, in this case, the carrying amount is the amount the accountant considered in the books of accounts. But in this case, when you talk about the tax base, is the amount the taxman will be able to consider whenever in this case, for example, is having to determine how much will be paid as a tax. So if you look at what you're having to be told in number 1, inventory is stated in the financial statements at the lower of costs and net realizable value. That is what the accountant is called upon to consider. Always to state inventory at lower of cost when you compare with what? Net realizable value. When you talk about net realizable value here, it is how much can be realized out of this inventory when you sell. So you always compare between the two. So according to International Accounting Standard number 2 on inventory, how inventory is valued, you basically compare what you'll be able to realize out of the inventory when you sell, you compare with cost. That is basically, in this case, what you'll be able to take as what? As the value of what? Of the inventory. So that is what, in this case, the accountant will be able to consider. The company wrote down its inventory by 120 million to a net realizable value of 1130. So what the NRV of this inventory, the NRV of this inventory was actually what? 1130. But of course, the cost, they had already written down. So it means that the initial cost here was actually what? Plus 120. So the initial cost of this inventory before having to write down, when you add 120, I think you get what? Is it 1250 or something? I think it's actually 1250. It's actually 1250. So that is what? The cost of this inventory. So that was the cost of the inventory, but they basically revalued it down. And of course, you're having to say the accountant, remember the carrying amount is the amount in the books of accounts, in the financial statements. It is not what the taxman will be able to consider. As you prepare the books of accounts for you as an accountant, always just know the carrying amount is what is in the books of accounts, the financial statements, what the accountant considered. So what the accountant considered here with regard to, in this case, inventory, with regard to this, in this case, inventory, was actually what? 1130. Was actually what? 1130. Was actually 1130. But of course, now in this case, what the taxman will be able to consider will be the costs. Will actually be the cost. Will actually be the cost. So that will be in this case what? 1250. Or you can be able to take the 1130 plus the 120. In this case, the taxman will be able to consider what? 1250. 12, the cost. He'll consider the cost. But the accountant, he'll have to compare between the two. The lower is the one he'll be able to take into the books of accounts. So the temporary difference here, when you minus the two, you get a negative of 120. You get a negative of 120. A negative of 120. A negative of what? Of 120. So that is what? A deductible difference. A deductible difference. So in this case, we say whenever you get a negative, it becomes what? A deferred asset. It will likely be a deferred asset. So it's a deductible difference. But of course, that is what's not the examiner asked that. But when you get the negative here, it becomes what? A deferred asset. A deferred asset. Then the next one, number 2, trade receivables had a carrying amount of 450. Of course, that one you've already been told. So the trade receivables, the carrying amount you've already just been told. The carrying amount was actually what? 450 million. 450 million. But what are you having to be told? In this case, about these trade receivables. So the trade receivables carrying amount of was 450 million after making a general provision for doubtful debts at 30 million. So remember, when you'll be learning about, in this case, computation of taxable profits in taxation, in this case, you likely end up having to be told that in this case, you have to add back any provision for what? For bad debts. You add back any provision for what? For bad debts. So in this case, the taxman will be able to consider the whole amount without considering what? The provision for bad debts. So what in this case, the taxman actually considered here will actually be 450. 450 plus what was actually allowed as bad debts. So the taxman doesn't basically recognize this provision. So what the taxman will be able to consider here is actually what? 480 million. Before what? Providing for the bad debts. But you, the accountant, from your financial accounting, you are told that in this case, when you are getting the figure for trade receivables, you have to provide for bad debts. Any bad debts, you minus bad debts and any provision for what? For bad debts. So that in this case, you can be able to get what? The carrying amount of what? Of the trade receivables. But that is not what the taxman will be able to consider. In this case, he'll be able to consider the whole amount of the trade receivables. The taxman in this case does not actually do what? Consider the allowables, the allowances for bad debts. So therefore, in this case, when you get the difference between the two, you get a negative of what? Of 30. A negative of 30. And of course, that is what? That is deductible. Is a deductible difference, which eventually becomes what? A deferred asset. If it's a negative, it is a deferred asset. It is a deferred asset. But if it's a positive, it is a deferred liability, a deferred tax liability. If it's a negative, is a deferred tax asset. So that is what was there. Then number three, what happened? Number three, what happened? Property, plant, and equipment has a carrying amount of 50 million and a tax base of 2750. Of course, that's when you've already been told. So property, plant, and equipment has a carrying amount of how much? 50. And in this case, a tax base that we've just been given directly, a tax base of 2750. So that means our temporary difference will be how much? That means our temporary difference will be how much? That means our temporary difference will be how much? Our temporary difference here will be how much? It will be 300. It will likely be 300. Is it a deferred tax asset or a deferred tax liability? It is a liability. It's a deferred tax what? Liability, because it is positive. It is positive. It will be referred, this temporary difference here will be referred to as what? A deferred tax liability, because it is positive. But these other ones are what? Are negative. So they are what? Assets. They are actually what? Assets. But what are we having to be told about this property, plant, and equipment? During the year, property was revalued upwards by 150 million. So there was a revaluation. So of course, I'll be able to show you how in this case, you consider the revaluation when you are preparing the deferred tax account. I'm going to show how in this case, you consider what? The revaluation when you are preparing what? The deferred tax what? Account. So this revaluation, basically in this case, you'll end up having to include it, or basically consider the deferred tax on this revaluation in the deferred tax what? Account. So we can proceed to the next one. During the year, development expenditure amounting to 480 million was capitalized. Amortization of 20 million was charged to profit or loss for the year. This development expenditure was allowed for tax purposes in full in the current year. So of course, now in this case, when you talk about carrying amount, sometimes I told you that in this case, this carrying amount, we normally call it also as what? As the net book value. As the net book value. So to get the carrying amount for this development, this development expenditure, the carrying amount for this development expenditure, you'll take what? You'll be able to take in this case the amount, the full amount, that is 480 million, you less the amortization. So that will be able to give you the carrying amount. For example, in this case, for you as an accountant, when you're getting the value of the asset, you normally take what? The cost of the asset minus what? Depreciation. So that you get what? The carrying amount. What I'm having to tell you, the carrying amount here, it is sometimes referred to as what? The net book value. It is what the accountant considered. It is what you normally do. Like, for example, in your financial accounting, when you are preparing. In this case, that's what you normally do. You get the carrying amount, you get the net book value. So it means that in this case, our development expenditure will actually be the 480 million. You less the amortization is like loss of value. It's like the loss of value. It's like loss of value. So when it loses value, the carrying amount eventually, in this case, will actually end up having to be 450 million. 450 million. But in this case, when you're told in this case, the asset was actually amortized, this simply basically means it was actually what? An intangible asset. It was an intangible asset. It was actually an intangible asset. These are simply assets. You can be able to have different categories of assets. Tangible, the ones you can be able to touch and feel physically. Intangible, you can't be able to touch and actually feel them, but it's still in this case, you consider them as what? As assets in your books of accounts. What you have to know from what this particular point, it is that for intangible assets, the tax base will likely always be zero. The tax base will likely always be what? Be zero. So whenever you're told about, in this case, what? Intangible assets. the tax base is actually always what? 0. And in this case, for example, to be able to know this, you're having to be told in the last sentence under this point that during the year, a development expenditure amounting to 480 million was capitalized. Amortization of 20 was charged to profit and on loss for the year. The development expenditure was allowed for tax purposes in full in the current year. So they had already, for example, considered the taxes for this development expenditure under the current tax. Remember, you're having to say you have two kinds of taxes, the current tax and the deferred tax. And what are you having to be told here? They had already considered the taxes here in the current year. So there's no any form of what, in this case, what? Any form of, for example, in this case, what will likely be considered as a tax in future. Remember, in this case, the tax base basically considers what the taxman will end up having to claim what in future. What the taxman will likely end up having to claim in future. So there's no any amount that they'll end up having to claim on it in future regarding what taxes by the taxman. So therefore, in this case, for intangible assets, know that in this case, always, if you're told about intangible assets, the tax base will likely always be 0. Therefore, in this case, our temporary difference here will likely come to how much? This one is actually 460, sorry. It's 460 minus 20. Minus 20 is actually 460. You can be able to correct that. It's actually 460. It's actually 460. The amortization was actually 20. So after amortization, the carrying amount or the NBV of the development expenditure is 460. Therefore, in this case, our TD becomes what? 460. It becomes 460. And of course, then in this case, it will become what? It will be a tax liability. So thank you very much for the correction. Then number 5, trade and other payables are carried at 600 million. Included in the other payables are accrued expenses of 100 million, whose related expenses are deductible for tax purposes on cash paid basis. So we have in this case trade payables. Trade payables. Remember, all these other ones, they are basically what? Assets. They're actually what? Assets. So not in this case, when you are considering the carrying amount, when you are considering the carrying amount and the tax base here, these ones will actually be negative. They'll actually be negative. They'll actually be negative actually here and here. They'll actually be negative. So in this case, for the trade payables, you're having to be told are carried at 600 million. So the carrying amount in this case for the trade payables is actually 600 million. But of course, I've already been able to tell you, since it's a liability, it will likely be a negative. It will likely be a negative like this. So the trade payables are carried at 600 million in the books of accounts. Included in other payables are accrued expenses of 100 million, whose related expenses are deductible for tax purposes on cash what? Basis, on cash basis. So it means that out of this, to get what in this case will be the tax base, we have to get the difference, which is actually 600 minus 100. So therefore, in this case, what the taxman will be able to consider for the trade payables will likely be 500. Will likely be 500. Will likely be 500. So when you get the difference between the two, you'll end up having to get negative 100. Negative 100. Negative 100. So when you take 600 minus 500, this one becomes, you're told it becomes what? Minus 600 plus 500. It becomes what? Negative 100. That is according to what your board mass. Is it board mass or something? So that basically will likely end up having to become what? The temporary difference regarding what? The trade payables. So you can be able to get the total. So the total in this case will be able to give you the total temporary difference. So what is the total temporary difference there? What is the total temporary difference? What is the total temporary difference? What is the total temporary difference? The total temporary difference, it is 510. It's actually 510. So 510. So that is the total what? Temporary difference. The total temporary difference. The total temporary difference. And therefore in this case, our deferred tax our deferred tax, will it be a deferred tax asset or a deferred tax liability? Will it be a deferred tax asset or a deferred tax liability? Will it be a deferred? It will be a liability. Mumbi, remember you're having to say always when the temporary difference is positive, it will lead to a deferred tax what? Liability. When the temporary difference is positive, it will lead to what? A deferred tax what? Liability. When it is positive, it will lead to what? A deferred tax liability. And of course, you've been told the income tax rate is actually what? 30%. So in this case, you'll be able to take 30%, multiply by the temporary difference, which is actually 510, which will be equal to, it will be equal to how much? A theta. It will be equal to how much? A theta. It will be equal to how much? A theta. Is it 1530? Remember already our figures are actually in millions. So they're already in millions. Remember our figures are already in millions. It will be equal to 153. It will actually be equal to 153. 153 millions. 153 million. So like that. So that is what the deferred tax what? Liability. If it would have been a negative, it would have led to a deferred tax asset. But since it's a positive, the TDs are positive, it is what? A deferred tax what? Liability. So that's what basically in this case you would have ended up having to do what? Deal with the first part, computing the relevant temporary differences. The relevant temporary what? Differences. The relevant temporary differences. So we can be able to move to the next part. How in this case you can eventually in this case build up or come up with what? The deferred tax account. The deferred tax account. So the deferred tax account. The deferred tax account. The deferred tax account. The deferred tax account. So the deferred tax account. So remember, our shillings are actually in millions. Our shillings are actually in millions. So if you look at note number 6, you're having to be told deferred tax liability at the start of the year. So the deferred tax liability, and of course, a liability account always basically has what? A credit balance. You know, a liability in this case always has what? A credit balance. It means it will be this side. It will be this side. If you are told it was an asset, it would have been this side. But in this case, it simply means that any liability always has what? A credit balance. But an asset has what? A debit balance. For example, in this case, you would have been told the deferred tax asset was this, then of course this balance at the start of the year could have come here. But of course, now in this case, you can be able to see. It was what? It was a liability. So in this case, it means that the balance brought down at the start of the year, the balance brought down at the start of the year was actually how much? 272 milli. 272 milli. 272 what? Milli. Then, of course, at the end of the year, we've already been able to see. We've already been able to compute at the end of the year. Remember, in this case, what you are computing in the first note, compute the relevant temporary differences. Then eventually, in this case, you have already been able to compute what? The deferred tax liability as of the end of the year. So in this case, the balance carried down, in this case, the balance carried down of the deferred tax liability, the balance carried down of the deferred tax liability is exactly what we've been able to get, 153 milli, 153 milli. But now there's something about what? Property, plant, and actually what? Equipment. So now in this case, I want to be able to tell you how in this case you consider what? Revaluation on property, plant, and actually what? Equipment. On property, plant, and actually what? Equipment. So any revaluation gain, if there was a revaluation and it was a gain, you credit the deferred tax what? Account with that revaluation gain, but you have to do what? Consider the deferred tax on that revaluation gain. So it will basically be 30% of the revaluation gain. So therefore, in this case, in our situation here, we are told property, plant, and equipment has a carrying amount of this. and a tax base of this. During the year ended 31st, property was revalued upwards. Since it was revalued upwards, it was a revaluation gain. Rule of the thumb, in this case, any revaluation gain, you basically credit it in the deferred tax account. So therefore, in this case, you'll end up having to put here revaluation gain. But now in this case, you have to consider what could have been the deferred tax on this revaluation gain by multiplying with the revaluation gain. It was how much? 150. 150. So how much are you having to get on the revaluation gain? Remember, if it was a revaluation loss, Mumbi, ungeyeka huku. If it was a revaluation loss, ungeyeka huku. But we don't have it. We don't. What you have is a revaluation gain. So how much are you getting? 30% of 150. 30% of 150. You're getting 45. You're getting 45. 45. You're getting 45. 45. 45. 45. So that in this case, I think all is actually complete. What we need to do in this case, we need to do what? Balance our deferred tax account. Balance our deferred tax account. Which side is more? Which side is more? Since the credit side is actually more. So what is the total here? What is the total there? What is the total there? A theta. What is the total there? A theta. A theta. What is the total there? 317. I think it's 317. And in this case, 317. The difference will actually go to the P&L account or the income statement. We'll go to the P&L account or the income statement. So the difference here will go to the P&L account or the income statement. Will it be an income or will it be a loss? Will it be an income or will it be a loss? Will it be an income or will it be a loss? Will it be an income? This difference here, which you're having to get in this case 164. I can be able to see you already gotten it. 164. Will it be an income or will it be a loss? What do you think, Betty? This 164. We're having to say you'll take it to the P&L account. Will it be an income or will it be a loss? I can see Mumbi says income. Akoyo. David Gitonga says loss. T says an income. It will actually be an income. It will be considered to be an income because it is going on the credit side. It is going on the credit side of the P&L. And incomes are normally credited on the P&L accounts. Ndio, kama ingekuwa hii side, kama hii balancing figure ingekuwa hii side, ingekuwa expense. Ingekuwa expense. And in this case, itaenda kama income. So it will actually go to the P&L account, which will actually be 100 and what? And 64. It was what? A gain. It was actually a gain. A deferred tax what? A gain. So in this case, it will actually basically end up having to go as what? As what? As an income. It will go as an income. It will go as an income. It will go as an income. So of course, there's something I've been able to mention, which I want you now in this case to note in your book. You can write NB. You can write NB or not like this. After that, patient can be able to write a note like this. You can be able to write a note like that. You can be able to write a note like that. Then you talk about this revaluation gain. You can be able to say any revaluation gain on an asset, 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 any revaluation gain on an asset will be credited in the deferred tax account. Will be credited in the deferred tax account. Will be credited in the deferred tax account. Any revaluation gain will be credited in the deferred tax account. Will be credited in the deferred tax account with the deferred tax on the gain. With the deferred tax on the gain. With the deferred tax on the gain. So you have to consider the 30% on the gain. With the deferred tax on the gain. Any revaluation gain will be credited in the deferred tax account with the deferred tax on the gain. With the deferred tax on the gain. With the deferred tax on the gain. So that is note number one. Then note number two. Note number two. Hope you've been able to write that one. Note number 2, any revaluation loss on an asset, any revaluation loss on an asset will be debited, any revaluation loss on an asset will be debited, it will come this side, will be debited in the deferred tax account, will be debited in the deferred tax account, will be debited in the deferred tax account with the deferred tax on the loss, 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 with the deferred tax on the loss. So that is basically, in this case, you'll be able to treat any revaluation gain you come across. But please be able to remember what you mean by carrying amount and, of course, the tax base. So the carrying amount is always what the accountant considered, is what you normally consider, like how you do accounts. But now, when the taxman is having to consider, for example, what you are supposed to be able to pay as taxes, they're not the same figures he'll be able to consider. So part of these figures, for example, he'll be able to call upon you maybe to pay a tax on them in future. So that's why in this case, we have to harmonize the two by having to come up with what we call the deferred tax, So therefore, under income taxes, eventually we'll have two kinds of taxes. We'll have the current tax, the one that was actually charged in the current year. And of course, in this case, we'll be able to have what we call the deferred tax. And of course, in this case, we're able to explain how the current tax actually arises in our previous class. So you're far much better off if you know, for example, in this case, how we say the current tax will actually, for example, be arrived at. So you'll just be able to take, for example, the 30%, or maybe in this case, the taxable profits. The 30% on the taxable profits. And of course, that is what you'll be taught in public finance and taxation. That what the accountant prepared is not what, in this case, for example, will be considered by Kenya Revenue Authority. But in this case, they're having to determine how much you'll be able to pay as a tax. You'll have to readjust. That profit that the accountant prepared. You come up with the taxable profit. That's why in taxation, for example, you'll be told you'll start with the profits in the accounts or in the books of accounts. You adjust, for example, by having to do add back disallowable expenses. Then you less in this case, for example, disallowable incomes. You add back disallowable expenses because they reduce that income. For example, the taxman doesn't, for example, consider depreciation as an allowable expense when you're computing taxes. It doesn't, for example, consider provision for bad debts when you're having to compute amount that is supposed to be taxed. Therefore, the essence of us having to do look into these matters concerning current tax and, of course, deferred tax. So we can be able to finalize. For example, in this case, assume in this case now you're having to look at what will be the tax expense. You're having to look at what would have been the tax expense, because in this case, the tax expense always will actually be a component of, for example, in this case, if you're having to consider what will be the tax expense for the year, for example, you are preparing published accounts, then in this case, it means that the tax expense will actually be equal to, in this case, the current tax. The current tax plus the deferred tax. The deferred tax. But of course, for this deferred tax, it can either be a gain or it can actually be a loss. For example, in our situation, you can see we're having to say it is an income. You're saying it is an income. So what will happen in this case, it won't be an expense. You know, for example, for this one, it will actually basically already be an expense, a current tax. For example, you take 30% of the taxable profits. But now the deferred tax here, simply because it is an income, you will add. And then in this case, you'll be able to get what would be the tax expense to be considered in the books of accounts for that year. But of course, in this case, if eventually it was actually, for example, still in this case, an expense, you'll be able to sum up the two. Remember, this one will actually be a negative. So when you add it, it basically reduce the tax expense. It will reduce the tax expense. But in this case, if it ended up having to, for example, in this case, still having to be, for example, a deferred tax expense, you'll add up the two. And of course, it will basically increase the tax expense. it will actually increase the tax expense. So let's say, for example, the current tax was actually, for example, 100. Already you know it is actually 100. So that is basically what you're having to less. For example, in this case, what? In your books of accounts or financial statements. And of course, now in this case also, this deferred tax is still actually basically what? An expense. It will actually basically further reduce what? Your profits. It will actually further reduce what? Your profits. But in this case, if it was a gain, you want less from the profits, because in this case, you have here the profits up here. You are lessing the expenses. You'll of course less the current tax. But now, in our situation, for example, you can see it as an income. So it won't be a negative. You'll add 164. But if it was an expense, you'll still actually basically less 164. That is, in this case, if in our deferred tax accounts, this particular balancing figure was on the credit side, it would have been an expense. So therefore, it would have ended up having to further reduce what? Your profits. But for our situation, it is a gain. So therefore, in this case, you won't less it, but you'll add it. You'll add it. You'll be able to add it so that in this case, you can be able to get what? The correct figure in terms of what? The profit after tax. The profit after tax. Profit after tax. So that's basically, in this case, now the deferred tax comes in, for example, to affect what would have actually been your profits for the year. And of course, I've already been able to explain as well. In this case, we also consider what? The deferred tax. The deferred tax. It helps us to harmonize what the taxman considers as what is supposed to be paid as a tax and what you yourself as an accountant you are considering, in this case, you'll be able to pay as a tax. Therefore, you have to look at, for example, what would be the taxman be able to charge me in future? And therefore, we arrive at what you're calling what? The deferred tax. The deferred tax. That is basically what you mean by, in this case, what? Deferred tax. So I want us to move to another area. I want us to move to another area. So if you look at the first topic there, it is accounting for assets and liabilities. Of course, we've covered current and deferred tax. But majorly what you've been able to say, the examiner focuses a lot on deferred tax. So you have to be keen and be able to understand how you arrive at deferred tax. Then in this case, I think you've covered leases. You've covered leases with the doctor. So now in this case, I want us to be able to cover the other areas, because there's a topic known as, in this case, preparation of published financial statements. So before we look at that topic, I want us to be able to understand the other areas regarding assets and liabilities, because in this case, we'll be able to rely on them, or basically make a reference to these areas under assets and liabilities when you start the topic of published financial statements. So the first area there you can be able to see, they're talking about what? Investment property. Investment property. So investment property is actually under International Accounting Standard number 40. So you can look at investment property, investment property. How do you deal with the investment property in your books of accounts? Because we'll be able to know investment property is actually International Accounting Standard number 40. International Accounting Standard number 40. International Accounting Standard number 40. So I want you to be able to write something about investment property, so we can be able to look at the definition of investment property. Definition of investment property. Definition of investment property. So what is investment property? So you can be able to write, it is a property. 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 In brackets, you can be able to put land. Land, it can be land or a building, or a building, or part of 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 a building, held by the owner, held by the owner, held by the owner, or lessee, held by the owner or lessee, or lessee under a finance lease, under a finance lease, under a finance lease, under a finance lease, to earn rentals, or for capital appreciation, for capital appreciation, for capital appreciation. So this is basically what we'll be able to refer to as what? As an investment property. So it is a property, in brackets, land or a building or part of a building held by an owner, or it can be a lessee, someone who has leased. Of course, you've learned about leases. You can have finance or operating lease, whereby under finance, there's that option whereby eventually there'll be the complete transfer of this asset to the lessee. So in this case, this property, maybe it is having to be owned by the lessee or the owner. And of course, what is expecting, it is to have some gains on this property. To have some gains on this property. For example, in form of rentals, or for example, in this case, maybe he's expecting this property will be able to appreciate. For example, when you buy land, so there's usually that expectation that I'm happy to buy it so that in future it can be able to appreciate, then I sell it. So people will be able to say, I've invested in in land. So that basically becomes an investment property. It becomes an investment property. So that is in this case what we mean by an investment property. So we can be able to give examples. What are the examples? Key examples of investment property. So number 2, key examples of investment property. Key examples of investment property. Examples of investment property. So number 1, you can be able to write land held for long-term capital appreciation. Land held for long-term capital appreciation. If you don't get the point, just kindly tell me to repeat. I'll be able to repeat. Land held for long-term capital appreciation. Land held for long-term capital appreciation. Land held for long-term capital appreciation. Then number 2, land held currently. Land held currently for a determined future use. Land held currently. Land held currently for a determined future use. Land held currently for a determined future use. Number 3, a building leased out. A building lease, when you lease out, when you have a building you lease out, so you want to get rentals. You want to get rentals. A building leased out. A building leased out. A building leased out by the owner. A building leased out by the owner under an operating lease. A building leased out by the owner under an operating lease. A building leased out by the owner under an operating lease. A building leased out by the owner under an operating lease. A building leased out by the owner under an operating lease. Number 4, a property being developed. A property being developed for future use. A property being developed for future use as an investment property. A property being developed for future use as an investment property. A property being developed for future use as an investment property. A property being developed for future use as an investment property. Then number 3, what are some of the examples of none? Examples of none. Examples of non-investment property. Remember what we've looked at is investment property. But the others in this case, of course, they are properties, but you must never consider them as investment properties. So examples of non-investment property. Examples of non-investment property. Examples of non-investment property. Number one, property used for production. Property used for production or supply of goods. Property used for production or supply of goods or services. So if you have a property and you are using it for production or supply of goods or services, and then it cannot actually be considered to be an investment property. So number one, property used for production or supply of goods or services. Then number two, property held for sale, e.g., an example you can be able to give, inventories. Property held for sale, for example, what? Inventories. This is simply goods you've been able to buy, you want to sell them. Yes, you can't consider them as what? As investment property. So number two, non-investment property, property held for sale, e.g., inventories. Inventories. Number three, property being constructed on behalf of a third party. Property being constructed on behalf of a third party. You can be a contractor who's ending up having to construct properties or buildings. So they can't be investment property. So property being constructed on behalf of a third party. Property being constructed on behalf of a third party. Number four, property occupied by employees. Property occupied by employees or owner-occupied property, like your own house. Property occupied by employees or the owner or owner-occupied property, like your own house. So you can't consider it as what? As an investment property. Property occupied by the employees or owner-occupied property. Then number five, the last one, property lists under a finance lease. Property list under a finance lease. Property list under a finance lease. So property list under a finance lease. So if you list out any property on a finance lease, then it won't be your own investment property. So the lessee is the one in this case you can be able to consider it as what? As an investment property. So property list under a finance lease. Under a finance lease. Under a finance lease. Under a finance lease. So you can be able to make a reference to a question that was tested regarding that area. You can say May 2017. You can write there with a red pen or something. With a red pen or something. May 2017, question number 1B. So I don't know where you write, but so long as you can be able to take note, what you've just been able to look at May 2017, question number 1B. Question number 1B. So they were testing what is investment property, which kind of properties can be investment properties, which kind of properties won't be investment properties. So you can be able to use a red pen. I don't know. You have a red pen or you have a black. I don't know which one you have. So then recognition. How do you recognize them in the books of accounts? So number 4, we can look at recognition. How do you recognize investment properties in the books of accounts or in your financial statements? For example, if you are called upon to do what? Prepare financial statements. How do you recognize? So recognition. Number 4, recognition. Recognition in the financial statements. How do you recognize investment properties in the financial statements? So number 4 recognition. You can look at recognition. Recognition. You can be able to write and say, investment property should be recognized as an asset. Investment property should be recognized as an asset. Investment property should be recognized as an asset when it is probable, that future economic benefits, when it is probable that future economic benefits that are associated with the property, investment property should be recognized as an asset when it is probable that future economic benefits that are associated with the property will flow to the reporting entity. Will flow. Future economic benefits that are associated with the property will flow to the reporting entity. Will flow to the reporting entity. And the cost of the property can be reliably measured. And the cost of the property can be reliably measured. And the cost of the property can be reliably measured. So long as this condition has been met, then you recognize them in your published financial statements as an asset. You recognize them as what? As an asset. So we're having to say in this case, you recognize them as an asset. So you recognize them at what value? You recognize them at what? At what value? At what value? So initially, you'll be able to recognize them at cost. But of course, as time goes by, you'll be able to recognize them at fair value. What I mean by fair value, maybe some of them could have ended up having to appreciate. So you have to, for example, in this case, consider the value of appreciation or the value of gain on the revaluation. So that in this case, you can be able to do what? Get what you'd be able to, for example, present in the balance sheet. So we can look at the next one, number five, measurements of an investment property. So how do you measure it? Measurements of an investment property. Measurement of an investment what? Property. So of course you're having to say it will be an asset. But at what value will you be able, for example, present it in the books of accounts or the balance sheet or statement of financial position? How do you measure it? So you can be able to write and say, it will initially be measured at costs. So initially when you, for example, it has been completed or constructed or when you've acquired it, you'll be able to measure it at cost. But of course, you've been able to say, as time goes by, maybe it can appreciate or it can depreciate. So it will initially be measured at cost. It will initially be measured at cost. It will initially be measured at cost and subsequently using the cost model, or you can go to say using the fair model, the fair value model, using the fair value model or the cost model. So we are saying how it will be measured. It will initially be measured at cost and subsequently for the coming, initially when you buy it or when you construct it, you'll measure it at cost. But of course, you're having to say subsequently something could happen. It can depreciate or some of them usually appreciate, for example, land. So it will initially be measured at cost and subsequently using the cost model or the fair value model, using the fair value model or the cost what? Model or the cost model, So you can go to look at the fair value. Number one, you can look at, first of all, the fair value. What do they mean you measure it at fair value? What do they mean you measure it at fair value? At fair value? This is the value at which, it is the value at which, it is the value at which the property could be exchanged. It is the value at which, the fair value, it is the value at which the property could be exchanged. The property could be exchanged between willing parties, between willing parties, between willing parties, between willing parties, by considering the market conditions, by considering the market conditions, by considering the market what conditions. It is the value at which property could be exchanged between willing parties by considering the market what conditions. For example, you'll be told that sahi hapa shamba inaenda 6 million, an acre hapa inaenda 6 million. So those are the market conditions you are considering. So it simply means that that land, you'll value it at what? At 6M. But maybe initially, when the person purchased it, it was at cost. Maybe it was at 3 million. So it has appreciated. It is an investment property that has eventually done what? Appreciated. So therefore, at that point in time, subsequently, you'll have to, in this case, measure it at fair value. What do you mean by fair value here? At that point in time, what will the parties be willing, for example, to exchange that kind of a property? At what value? That basically becomes what? The fair value. And of course, the fair value is normally arrived at when you consider other factors, let's say, for example, the market what? Conditions. That's what I mean by what? The fair value. Then you write and say after that you can put a full stop and say any gain or loss in exchange of investment property, any gain or loss in exchange of investment property should be recognized. Any gain or loss in exchange of investment property should be recognized in the profit and loss account, should be recognized in the profit and loss account. Any gain or loss in exchange of investment property should be recognized in the profit and loss account as a profit or a loss. As a profit or what? A loss. So if it was a loss when you sold it, then it will be expensed as a loss. If there was a gain, it will basically be attributed to the income statement of the P&L account as an income. So you'll have to consider that. Then number 2, we're talking about the cost model. So the cost model, number 2, what is the cost model here? So number 2, under the measurement, the cost model. The cost model, how do you deal with it under the cost model? So you can put a semicolon or something and say, after initial recognition, comma, investment property will be accounted. Investment property will be accounted after initial recognition. Investment property will be accounted. Investment property will be accounted as per IAS 16, as per International Accounting Standard number 16, International Accounting Standard number 16. In brackets, you put property, plant, and equipment, or PPE. This particular IAS deals with the property, plant, and equipment. Will be accounted as per International Accounting Standard number 16. What do you mean by this, i.e.? What do you mean by this? What do you mean by this, i.e.? The cost less accumulated depreciation, i.e. the costs of these assets, less accumulated depreciation, or impairment loss, or impairment loss. So That is when you're using the cost model. You take the cost, you less the accumulated what depreciation, or you less what the impairment loss on that particular what assets. So that is basically what in this case you'll be able to recognize where in the books of account. That is basically majorly what you normally do. You take the cost, you less the depreciation, you get the net book value. So you can be able to end by putting a note, an NB. You can put an NB. So of course you've been able to see there are two ways, fair value, or you can use the cost model. So you can put an NB and indicate. An entity will adapt. An entity will adapt one method of valuation. An entity will adapt one method of valuation on all its investment properties. On all its investment properties. So you'll be able to decide. Well, if you're using fair value, you adapt it for all what your investment properties. If you're using, in this case, the cost model, you adapt the cost model. You adapt what the cost model. So you'll choose one. You don't use both of them because you can be able to see they are different methods. Look at the fair value model or the cost model. So you adapt one and you use for all what your investment what property. So an entity will adapt one method of valuation on all its investment properties. On all its investment properties. So you just adapt one. You just adapt what? One. Adapt one of them. On all the investment what? Properties. On all the investment properties. On all the investment what? Properties. So that is basically what will likely end up having to happen regarding what the investment property. So if you sell the investment property, then you no longer basically recognize it in your books of accounts. So it won't appear in your balance sheets. And of course, if there's actually any gain when you dispose, then it means that you'll be able to recognize it as a profit or a loss, as a profit or a loss in your financial what statements, in your financial what statements. So that simply means you take what the cost maybe of construction or the cost of the assets or the fair value of the asset, you less what you've been able, you less from what you've been able to realize out of the sale, you'll get either a gain on disposal or a loss on disposal, which in this case will eventually come to be, for example, the profits in the profit and loss what account, profit and loss account. So that's basically how in this case you deal with what we call what investment properties, investment properties. So I want us to look at another one. So that is all to do with what investment property and how you'll deal with it. So part of this we'll be able to use when we start looking at the area of published financial statements. Published financial statements. We have to understand, first of all, the topic of assets and liabilities before we look at published financial what statements. So I want us to look at another one. In this case, we refer to as non-current assets held for sale. So you have non-current assets held for sale. So non-current assets held, non-current assets held for sale. So this one is under International Financial Reporting Standard number 5. It is under International Financial Reporting Standard number 5. International Financial Reporting Standard number 5. So of course we can be able to start by looking at number 1, the definition. What are these? What are these non-current assets held for sale? What are these non-current assets held for sale? So you can be able to say these are assets. These are assets which an entity plans to sell, which an entity plans to sell. They are simply assets which an entity plans to sell. So these are assets. These are assets which an entity plans to sell them. They are planning to sell them. They are planning to sell them. So what are the features? So features of these non-current assets held for sale. What are the features of these non-current assets? How will you know it is a non-current asset the entity is holding to sell. How will you know? What are the features? So feature number one, for you to be able to know whether it is an uncurrent asset, they are simply just holding, they'll sell it. Number one, the management has committed to a plan. The management has committed. You can see what they have been able to do, the management of that entity. Number one, the management has committed to a plan to sell the assets. The management has committed to a plan to sell the assets. The management has committed to a plan to sell the assets. Yani wameanza harakati. Ukiangalia vile wana behave, wameanza harakati. Ni kama watauza your asset. We'll be able to categorize that what? As an uncurrent asset, they are simply holding, they'll be able to sell it. So management commits to a plan to sell the assets. You can give an example, e.g., identifying the asset, comma, e.g., identifying the asset, comma, setting an expected date for completion of the asset, setting an expected date for completion of the asset, setting an expected date for completion of the asset, setting a completion date for completion of the asset, etc., amongst other things. Amongst other things could be examples to be able to show that they are committed to what? To sell the asset. Setting an expected date when the asset will be completed so that they can be able to sell. Then number two feature about these non-current assets held for sale. Number two, the asset is available for sale in its present condition. The asset is available for sale in its present condition. It is available for sale in its present condition. For example, those ones who are involved in real estate development, sometimes you realize that in this case, the houses are not complete, but they are saying they are selling what? Is it off plan or something? I don't know, off plan. So they are already selling. So the asset is available for sale in its present condition. So that will be an uncurrent asset held for sale. The asset is available for sale in its present what? Condition. Then number three, the management has initiated an active program. The management has initiated an active program to locate a buyer. The management has initiated an active program to locate a buyer. To locate a buyer. The management has initiated an active program to locate a buyer. You can give an example. What could they be doing? E.g., you can give an example. E.g., marketing or initiating discussions, marketing or initiating discussions with third parties. Yani washaanza kumarket. So wanako kila mahali, flyers kutembea social media wapi. So that will be an indication that is simply an asset the entity is holding, they'll be able to sell in future. That is another feature for you to identify whether it is an uncurrent asset that is being held for sale. So they are marketing or initiating discussions with third parties. Number four feature for you to know, the sale is probable. The sale is probable and is expected to be closed within a year. And it is expected, yani you deal with a sale within a year. So the sale is actually very probable. The sale is actually probable and is very probable and is expected to be closed. Is expected to be closed within a year. Is expected to be closed within a year. Then number five, the selling price is reasonable the selling price is reasonable. The selling price is reasonable in relation to the asset's current fair value. The selling price is reasonable in relation to the asset's current fair value. If you look at the selling price they've been able to set, it rhymes with the market conditions, with the fair value of that asset. Because you're having to say, when you talk about fair value here, is basically having to consider what are the prevailing conditions as to how that asset should actually be valued. So you consider the market conditions and you're comparing with what they have been able to set as a price. They're almost matching. So that basically is another indicator. This is just an asset that they are holding. They'll be able to sell it without what prevailing price or that selling price they have been able to set. Then number 6, which is the last one feature to know, which is an non-current asset held for sale, the last one, number 6. It is unlikely there will be any changes. It is unlikely there will be any changes in or withdrawal. It is unlikely there will be any changes in or withdrawal of the plan to sell the assets. So what you are having to see, they won't change. So it's unlikely there will be any changes in or withdrawal of the plan to sell the assets. There's no any changes, for example, not to sell the assets. So that will be a feature to indicate it's just an asset they are holding. They'll be able to sell it. They'll be able to sell it. So now in this case, number 3, what is the accounting treatment? How basically do you deal with these assets in your books of accounts? So number 3, the accounting treatment. Remember, number 1 was definition. Number 2, features. But now, how do you account for non-current assets held for sale in your books of accounts? So the accounting treatments. The accounting treatment in your books of accounts. The accounting what? Number 3, the accounting treatments. Number 3, the accounting treatments. The accounting treatment for non-current assets held for sale. Sasa utadili nazo aje ukifanya accounts zako. So number 1, or you can just be able to say, they will be measured, and right under that, they will be measured at the lower of the carrying amount. They will be measured at the lower of, they will be measured at the lower of the carrying amount, the carrying amount. Remember the carrying amount tunasema inaitwa pia nini? The carrying amount tunasema inaitwa pia nini? The carrying amount, NBV, yes, NBV. The carrying amount inaitwa pia nini? NBV. You can be able to call them also this one as net book value. The law of the carrying amount, and you compare with, in this case, and the fair value, the law of the carrying amount and the fair value, less the costs to sell, less the costs to sell, less the cost to sell, less the cost to sell. You can be able to give an example, write an example, give an example here and say, and give an example here and say, if an asset, give an example there and say, if an asset has been purchased at 20,000 shillings, if an asset has been purchased at 20,000 shillings, if an asset has been purchased at 20,000 shillings, if an asset has been purchased at 20,000 shillings, and has an accumulated depreciation of 9,000 and has an accumulated depreciation of 9,000 and has an accumulated depreciation of 9,000. If an asset has been purchased at 20,000 and has an accumulated depreciation of 9,000, comma, its carrying amount will be, semicolon, then you say 20,000. The carrying amount will be 20,000 minus 9,000, which in this case will likely be equal to 11,000. Likely be equal to 11. So that basically becomes the carrying amount, or what you're having to call what the net book value. The net book value. The net book value. So that will be what the carrying amount. Then another point, you can be able to write another point. Another point, I don't know what you are using, bulletins or something, or paragraphs, right? And say the fair value of an asset, is the estimated worth. The fair value of an asset is the estimated worth of the assets in the markets. Is the estimated worth of the assets in the markets. Is the estimated worth of the assets in the markets. Is the estimated worth of the assets in the markets. Is the estimated worth of the assets in the markets. Full stop. Then you write and say, suppose the fair value of the assets mentioned above, the ones we used in the example, suppose the fair value of the assets mentioned above is 12,000. Suppose the fair value of the assets mentioned above is 12,000. Suppose the fair value of the assets mentioned above is 12,000. And the cost to sell, is 3,000. And the cost to sell, zile cost to time kando uze. For example, inaweza kuwa marketing costs. And the cost to sell is 3,000. And the cost to sell is 3,000. And the cost to sell is 3,000, comma, then the fair value less the cost to sell will be, then, comma, then the fair value less the cost to sell will be in brackets 12,000, will be in brackets 12,000 minus 3,000, which is equals to 9,000, which is actually equal to 9,000, which is equals to 9,000, which is equals to 9,000, which is equals to what? 9,000. Full stop. Then you write the final point there. You say, in this case, the assets held for sale will be shown in the balance sheet as, in this case, the asset held for sale will be shown in the balance sheet as how much? In this case, the asset held for sale will be shown in the balance sheet as how much? Will be shown in the balance sheet as how much? In this case, the asset held for sale will be shown in the balance sheet as how much? Will be shown in the balance sheet as how much? Who can be able to try and say how much? In this case, it will be 9,000, because we've been able to say that under non-current assets held for sale, the accounting treatment, what you'll be able to recognize in the books of accounts or the financial statements will be the lower of the carrying amount, and you compare the two. It's like the carrying amount versus Manchester United versus Liverpool. So you'll take what? Liverpool. So this one is Liverpool. The fair value less the cost to sell is actually Liverpool. So in this case, you'll be able to take the lower of the two. The lower of the two is actually the 9,000. The other one was actually coming to what, 11,000. So you'll take what, the lower of the two. In this case, you'll be able to take what, 9,000 to go to the balance sheet. So remember how you recognize these kind of assets in the balance sheet. You basically take the lower of the carrying amount and of course what, the fair value less the cost to sell is what you'll be able to recognize in the financial statements. Then the last paragraph, the very, very final paragraph, you can be able to write and say, according to IFRS 5, the relevant standard for non-current assets held for sale, according to IFRS 5, comma, assets held for sale, 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 should be presented, assets held for sale, should be presented, should be presented, should be presented in the statement of financial position, should be presented in the statement of financial position, just like what you've already been able to say, should be presented in the statement of financial position, should be presented in the statement of financial position, should be presented in the statement of financial position, should be presented in the statement of financial position, statement of financial position. So that's basically how in this case you recognize or identify. That's how we can be able to identify an asset is an non-current asset they are simply holding. They'll be able to sell it in future. So of course it will still be their asset, but of course in this case it simply means that they'll basically still recognize it while it is still what, maybe their asset. That is how they'll be able to recognize it in their books of accounts, in their books of accounts. So in their books of accounts. So we can be able to maybe end there for now. We can end there for now. So next, I think we'll be able to look at these other parts of financial assets and financial liabilities. Then assets used in exploration, then provisions for contingent liabilities. Then after that is when you can be able to tackle now, in this case, published financial statements. That is, I think, topic number, it is topic number, I think topic number 4. So once you understand assets and liabilities so well, see when, because part of this we'll be able to use in what, published financial statements. So we'll be able to now start covering published financial statements. So I think we can end there for today. We'll cover the other areas on the first topic, that is provisions for contingent liabilities, and of course what, assets, contingent liabilities and assets. Then of course now in this case we'll also be able to look at the other area of assets used in exploring for and evaluation of mineral resources. Then we'll clear up with the topic number 1. Then we'll be good to go to cover published financial statements. So I don't know if there's any question up to that point, but I would wish to end there. So those who have joined late, make sure you try to catch up with the videos of what has actually been covered. So a number of areas have been covered, like leases, like in this case, borrowing costs, we've covered. Agricultural activities or farming has been covered. I think cooperative societies also has been covered. Yeah, so you need to check out. Borrowing costs, income taxes we've covered, leases has been covered. So you need to catch up with what has actually been covered as we move on. So I don't know if there's any question. So leases, you didn't do a past paper question. So I think you'll continue with the session. You'll be able to continue. I think is it tomorrow or when? There's another class, I think tomorrow, because me, I'll be coming in on Friday. I'll come in on Friday. But I think for leases, I think you are not yet through. So you need to cover maybe operating lease and of course financings. Then I think you'll be good to go. So I think you'll be able to do a question from the past papers. You'll be able to do a question from the past papers, I think, in tomorrow's class. Is it tomorrow or Thursday? I think Thursday. Could be Thursday, I don't know. But I'll come in on Friday. I'll come in on Friday. Any other concern? Any other concern? Any other concern? Those who don't have the past papers, you get them from the group description on the WhatsApp group. This is there are past papers there, you can be able to get them. There's a link. Deferred tax still feels a bit challenging. Are there any more questions we can do for assignments? So I'll be able to share. I'll be able to share a question you can be able to attempt. I'll be able to share. I'm going to share on the group so that you can be able to attempt. So you need to do exercise. So you need to do exercise about it. It is not that hard. So once you get the concepts, carrying amount and the tax base, what is the difference? So you'll be good to go. You'll be good to go. And of course, the format does not actually really change. The format is just the same. So the format you're just applying here, the same format you'll be able to apply in almost all the questions if they are tested. So long as you know what will be the carrying amount, what will be the tax base. Then the difference is the temporary difference. And then the corporate tax rate, you compute with the temporary difference, you get the deferred tax. And then you know the concept of coming up with the deferred tax account. Then you'll be good to go. You'll be good to go. The videos are on the LMS. There's a portal. There's a portal you can be able to access. There's a portal you can be able to access. The videos are on the LMS. On the LMS. So what you do, I don't know. Maybe I'll be able to say there's a procedure you're supposed to follow. For H, there's a procedure you're supposed to follow. I'll tell the LMS admin. I think frequently is sharing the details there. So you'll be able to see how you can be able to register, then you'll be connected. So that's why in this case, you end up having to get, so hope you still have to have hope. Don't give up. Don't give up. Don't give up. You still have to have hope. Huh? Hope. You still have to have hope. Don't give up. So I'll give another question you practice, the deferred tax area. The deferred tax area. But of course, also we'll revise it once we've also been able to cover the other areas. Otherwise, thank you very much. Have a good night. Let's catch up on Friday. Asanteni sana.